What? It returned almost 50% profit with 98% success rate? This can't be true. Let's be honest that DCA is not a particularly popular strategy amongst investors and it is often misused just because of the lack of understanding. How can something so simple give good results? Let's have a quick review of what DCA actually is, as the name is somewhat misleading. In simple words, dollar cost averaging is the approach where instead of making one upfront or lump sum investment, a buyer spreads out its investments into small purchases over time, hence being able to achieve an average cost from various purchases. What this really does, it helps reduce the emphasis on correctly timing the market through the application of law of averages. If you regularly follow my videos, I always put these theories to test before I start believing in them. What intrigues me is that how can a strategy that only requires small investments over time, disregarding any form of technical analysis, return profits in the long run? To make my test more interesting, I decided to commence my testing period right before COVID-19 lockdowns, hence starting in January 2020. After all, it is a prime example of economic disruption and uncertainty. Instead of making one lump sum investment, I will make regular small investments, buying a fixed number of shares every month. And finally, I will close my positions close to September 2024. For my first test run, I used Apple stock. Let's have a quick look at the results. What? It returned almost 50% profit with 98% success rate? This can't be true. After all, this is as simple as it can be. If these results are true, I'm really shocked. Let's have a quick review of what I had done. To be honest, I did not do anything extraordinary. All I did was keep purchasing 5 shares of Apple stock every month, disregarding the price and any emotions I had about the price movement. Here is a snapshot of all my purchases, and when I finally closed my positions, selling 285 shares at the selling price of around $222 each. If nothing else, these results at least demonstrate that DCA strategy clearly has its merits and it might be worth exploring. For the sake of argument, what if I had instead made an upfront lump sum investment of the same number of shares and held these positions for the same period? Let's see the results in this case. The results may be twice as good, and that's the argument that a lot of studies make, that making upfront investment will be better in a higher number of cases. But this doesn't mean that we should disregard DCA approach completely. In a lump sum approach, the entire investment is made upfront, and the assumption is that the position will be held for a long enough time to return profit. On the other hand, in a DCA approach, a fixed amount is invested at regular intervals regardless of the market price. One important element to note is that if you are investing a fixed amount at various points, the number of shares will also vary inversely to price. This allows to double down on the benefit of lower prices and acts as a sort of weighted average instead of a simple average, providing an opportunity to better improve the average price with every price drop. Okay, we now know that lump sum investments generally outperform DCA. But then there is one very critical element that we cannot ignore. That is the emotions involved with making big investment decisions. Let's face it, not many of us have huge piles of funds to spare that we are okay taking losses on. At least I don't. So this is how most of us behave. We wait for additional confirmations before making a big investment decision, and as the price drops, we get nervous, thinking that this drop is not a temporary correction and the company may be in for big losses. At this point, most of us decide to cut our losses and close this position. And when the price finally starts growing up, either we have stopped looking at the stock because it brings bad memories, or we comfort ourselves by thinking that the risk was much greater than the reward. Therefore, there are a few key things we should know about DCA. The first one is that applying DCA in a single asset may not be a very good approach. While there is nothing wrong in particular with this approach, it just brings additional risk if the quality of the asset is not very good, as our DCA approach relies on the fact that our eventual ending price should be better than our average price, and for poor quality assets, this assumption may not be valid. Therefore, it is really important that if we are doing a long-term DCA, the underlying asset quality should be really good. Let's look at an example. This is an asset I traded in the past following a market advice. This was around the time the price was around its peak. If someone was investing in this asset using DCA approach as it was increasing in price, it doesn't matter how much more is invested to improve the average price, it will be near impossible to exit with profit in near future. It may therefore be easier to apply this approach in a diverse portfolio as it will help manage the overall risk in the portfolio. Another approach that traders often apply is to make additional investments during market pullbacks. This approach is slightly different to the classical DCA approach but can help provide additional boosts in profits. Using technical indicators can sometimes help identify the right zones for investment. The biggest benefit of using DCA approach is the psychological advantage that it brings. Spreading the investment over a time and making it in small chunks removes the emotions from investments and turns it into a habit. By following the asset, people also tend to gain more knowledge about the asset price movement and make better informed decisions, and also lose the nervousness when the price downturns. While we already discussed that lump sum investments are in general more profitable than DCA, but there are two things that we need to understand. One, are we able to pick the right asset? Secondly, are we able to find the right time, if not now, to make the investment? Let's face it, both these things are not so simple to decide for an average investor like us. And finally, DCA also helps in managing the overall risk of investment. While funds are an important factor in investing, information and intelligence are equally important, and that only comes with time. Having not invested everything upfront allows for the approach to be adjusted if the results are not following the trader assumptions. But I know it's not so easy to make these decisions, so I always ask myself two questions. One, is this the lowest price that I will ever find? Secondly, does this asset have strong fundamentals and will it eventually grow in value in the long term?